presentar. Buenas tardes a todos. Es para mí un placer presentar y moderar este webinar junto con Mike Arslen y Carbon Cap, titulado Carbon as an Asset Class, the Focus on Regulated Markets. Primero de todo, comentar que la sesión va a ser grabada para poder luego ser seguida por el resto de personas asociadas a CCA Institute. CFA Institute ha mostrado un compromiso creciente con la sostenibilidad reflejado en la cada vez mayor inclusión de temas relacionados con los factores ESG en su currículum y en la oferta de cursos formativos específicos. Fruto de ello fue la creación del Comité de Sostenibilidad de CFA Spain, que nació en 2019 y que recientemente se ha renovado. Uno de los objetivos principales de este comité es el de promover y afianzar en España el certificado de CFA ESG Investing, que desde su lanzamiento en el 2019 pues ya tiene en total a nivel mundial más de 25.547 personas con la certificación, 410 de ellas en España. Y también CFA Institute está enfocándose muy mucho en fomentar también otros cursos ligados a la sostenibilidad, como el recientemente lanzado Climate Risk and Valuation Investing Certificate. Voy a cambiar ahora en inglés. I am going to switch now to English. In today's session, we will delve into the intricate world of carbon markets, focusing on the regulatory framework that govern carbon credits. As the fight against climate change intensifies, understanding the mechanism of carbon trading has never been more crucial. Carbon credits serve as an essential tool in reducing greenhouse gas emissions, enabling companies to offset their carbon footprint by investing in environmental friendly projects. This event will give us deeper the knowledge to navigate the complexity of carbon markets, comprehend regulatory standards, and effectively engage in carbon credit transactions. Let's get a start on this journey toward environmental stewardship and market proficiency. We have the privilege here to have with us Michael Aslen. Michael Aslen is graduating the London Business School, specialist in climate change and carbon markets. He is a senior investment professional with more than 25 years of industry experience, including the founding, growth, and a scale of a regulated investment management business to a public company. Michael, for many years, has focused on research into climate change and impact strategies. Michael formed Carbon Management as an environmental asset manager focused on carbon markets and climate impact, and launched the World Carbon Fund in February 2020. The fund invests into multiple liquid and regulated carbon markets and has generated a net return of more than 115% over 4 years track record. It is really a pleasure for me having you here, Michael. Please, the floor is yours. Thank you very much.
Thank you, Augusto, and thank you for inviting me to present to the CFA Society in Spain this evening. Welcome to our guests tonight. I'm hoping that this will be an educational event for you to learn a little bit about an update on climate change, carbon markets, and then at the end, I'll tell you a little bit about the World Carbon Fund, our impact fund. So this is the agenda for today. Climate change, carbon pricing, and then specifically emission trading systems. I will cover a little bit about the voluntary carbon market, although that is not the focus today. I'll take you through a little bit of our research on carbon as a liquid alternative asset class that is now really growing, and finally a little bit on the fund. So Augusto provided you a background. I'm Canadian, but I have been living and working in London now for 30 years after completing my graduate degree at London Business School. I am a guest lecturer on the graduate degree program at London Business School. My professional background is as a proprietary trader with 2 of Canada's banks, and then I worked in the alternative investment industry in London in a number of roles. I founded my first regulated business in 2005 This business grew to over 700 million assets, and I was very fortunate to sell the company to a Swiss public company. After my earnout period, this is when I became focused on climate change as an issue, and that led me to enroll at the London School of Economics, another esteemed institution in London, into the climate change program in 2018. And I learned many things in this program, but this is where I was first exposed to carbon markets as a policy mechanism to address emissions. And once I understood the mechanism, I looked at the trading of this asset class, carbon, which is mainly futures related. Like many commodities, most of the liquidities in the futures market. And in 2018, carbon markets were trading 10 billion US dollars per month, monthly liquidity. And when I saw this liquidity, I was intrigued about the statistical properties of this liquid asset class: historical return, volatility, correlation. These were the questions. When I searched for academic research, there was none. So I hired a PhD student from the London School of Economics, and we collected the data on all key carbon markets. We wrote this up as a research paper, and after 3 years in the peer review process, the paper was published in 2022 in the Journal of Alternative Investments, called The Carbon Risk Premium. And I will share the key conclusions from this research with you today. This research and the underlying data set was really the foundation for my current company, Carbon Cap Management, which is an environmental asset management business with two objectives. Objective one, generate absolute return, and objective two, create real climate impact. Very important to me in this later stage of my career. We launched the World Carbon Fund 4 years ago, as Augusto mentioned. It is now the largest carbon fund in the world, and it has performed very well, and it has also created significant impact. So very pleased about that. So let's begin with a quick review on, of course, on climate change. When we look at the atmosphere, we think it's infinite or almost infinite, but actually it's a very thin layer around our planet. And into this very thin layer, we are emitting about 160 million tons of CO2 into the atmosphere every 24 hours. And of course, the main source of this global warming pollution is fossil fuels: coal, gas, and oil. And you can see from this graph where we're now at about 36 billion tons of annual emissions, that it is a very exponential graph. And the only graph that is similar to this is human population. And as population has increased, our consumption and burning of fossil fuels has increased, and our annual output of greenhouse gases has increased, including last year in 2023, a new all-time record emissions. Of course, when the emissions go into the atmosphere, they accumulate. And so the concentration of CO2 in the atmosphere has been increasing rapidly since the 1950s and is now more than 50% higher. And you can see that this graph this data was started to collect by Charles David Keeling in the late 1950s. And as we keep emitting more, we keep increasing the concentration of CO2 now to 420 parts per million. And we understand CO2 as a gas. The properties of this gas: it traps heat. So as we increase the concentration in the atmosphere, it's like we wrap the planet with a blanket and we trap the heat within the planet. And of course, with that higher concentration, we are seeing a significant departure in temperature from average temperatures. And this is likely, of course, to continue as long as we keep emitting CO2 into the atmosphere. In fact, 21 of the last 22 years have been the hottest years, and the last 8 years have been the hottest 8 years ever on record, with, of course, last year will be the hottest year on record, although 2024 is already on track to maybe be another new record. What comes with heat? Many, many negative aspects: forest fires, flooding, drought, crop production reduction, and perhaps most concerning is climate change impacts the poorest people in the world with the lowest carbon footprint, who have the least ability to be resilient from the impacts. So many, many people in the emerging world will simply migrate. No food, no water, too hot to work outside, so they will move. And this is becoming, I think, a major issue, because many, of course, will come to the European borders and will want to come north into Europe. And the UN estimates we could have 500 million migrants coming to Europe due to climate change migration in the coming decades. And this could cause political and social instability. Weather catastrophes are increasing dramatically, and therefore, even if you take away the moral and ethical issues of climate change, if you just look at the economics are clear. The damages far exceed the benefits we gain from burning the fossil fuels, and we must therefore, on a cost-benefit basis, we must look at how we can reduce our emissions rapidly. Historic emissions are the blue line, and I call this the biggest supertanker in the world. And in order to achieve the Paris Agreement of a 2-degree or 1.5 degree, this is the pathway that is required. And I can't speak for you who is viewing this, but when I look at this graph, I see the enormous, enormous challenge, right? With this being the current pledges, which is far inefficient, which will lead to 2.6 to 3 degrees of warming. And that level of warming, we have already warmed the planet by 1.1 degree. Between 2.5 and 3 degrees, this is catastrophic for our species and many, many other species on the planet. So what are the solutions that policymakers have tried to bend the curve of emissions down? When I was at LSE, we studied all of the policy tools that governments have tried to bend emissions lower. And I can tell you the only consistent tool that has worked is putting a price on emissions. Because the global economy now is driven by really 3 things: supply, demand, and price. It's a global market economy which respects and reacts to these 3 dynamics. And therefore, by putting a price on emitting carbon, it does, and it has been, the most successful mechanism. Jim Yong Kim, former president of the World Bank, says there's never been a movement to put a price on carbon at this level with this degree of unison. So we do have 2 different carbon markets in the world today. We have the regulated carbon markets, which we call the compliance carbon markets, and we have voluntary carbon markets. And I just quickly want to go through a little bit of the key differences between these 2, and then we will do a deep dive into the regulated carbon markets so you can understand how the markets actually function to achieve their objective of lowering emissions. So compliance carbon markets have mandatory participation for the biggest emitters. They are audited every year. There is high penalties, and we have 99% compliance. Today, they cover 16% of global emissions, with many new countries launching carbon markets. I will elaborate on this in a few moments. These markets are highly regulated. They're very liquid. So in 2022 and 2023, they traded about $1 trillion US. So this is a liquid market, and the supply is capped by the government and is reduced every year. So this is the regulated markets. But there is, for most people, when they hear carbon, carbon credit, carbon offset, these words credit and offset, these are used for the voluntary carbon market, not for the compliance market. In the compliance market, we use the term carbon allowance permit because each permit allows you to emit 1 ton of CO2 into the atmosphere. In the voluntary market, this is normally a project. So most people here, we will plant some trees, we will protect some mangrove swamps, we will do something related to nature that is a project. There's a variety of different standards, so there's not one standard. Mainly these are used for corporate offsetting. This market, unfortunately, there is almost no regulation. There is no formal financial regulation in the voluntary market. And that's quite amazing when you think about how our financial instruments are regulated so heavily today in 2024. And a carbon credit and a carbon offset, these are financial instruments, and yet there is no independent financial regulatory oversight. The liquidity and the size is very small. The difference in size is about 1,000 times. So this is a major difference in size. And one of the issues with the voluntary market is there is effectively an unlimited supply of these credits and offsets. I have done a deep investigation of the voluntary carbon market. We do not participate in that market, and I highly recommend to all of our clients not to participate in the voluntary market because there have been multiple scandals and issues, and it can have a negative effect on your reputation as a company if you are involved in a project where something happens. So until this market becomes regulated, my advice is to steer clear of the market. So let's talk about the regulated markets, and let's go through step by step how these markets work to reduce emissions, but achieve the reductions at the lowest cost to society. Very important. We don't want to reduce emissions at any price. We must reduce emissions at the lowest possible cost. Here's how the carbon market works. First, there is mandatory inclusion for any company that has emissions above a threshold. Typically in Europe, this is 25,000 tons per year. So these are the big emitters. Who is it? The power sector. They burn coal and gas to make electricity. Steel, cement, chemicals, oil refiners, the big emitters. They are notified by the government and they are in the market, mandatory. This means they are audited by the government on their emissions every year, and they must submit permits that equal their emissions. So last year, if your factory in Europe is above the threshold, you emitted 2 million tons of emissions. By April this year, you must give the government 2 million permits. If you don't, the penalties are very high. And so we have 99.9% compliance from these big companies. The carbon allowance permits, these are allocated and auctioned by the government. So in Europe, we have an auction every day where the government sells the permits in an auction and companies bid to buy the permits because they know they will need the permits at the end of the year. And each allowance permit permits you to emit 1 ton of CO2. The total supply is capped by the government, and every year this supply is reduced. And this means that emissions within this ecosystem, emissions must go down. This is the first thing I like about this policy, this mechanism, is it has environmental integrity to lower emissions. So let's go through an annual 1-year cycle. So in Europe, approximately total supply of permits is 1.4 billion tons. So these permits are allocated and sold into the market by the government. At the end of the year, all of the companies are audited. And in Europe, 15,000 big emitters. And let's assume that the total emissions is also 1.4 billion tons. So these companies are audited, and then they must give the permits back to the government. So each company gives the permits 2 million tons, 1 million ton, 3 million ton. The government says yes, no penalties. Now the government has all the permits back at the end of the year. What does the government do? Destroys the permits. These are permanently destroyed. And then in the next year, the government issues 1.3 billion. Destroy. Next year, 1.2, 1.1, 1, 900. So by lowering the supply of permits each year, we force some company to select themselves to decide we need to reduce emissions because there's not enough permits. And the key is which company will decide. And this is the beauty of the mechanism. Because companies buy and sell the permits in the secondary market, and this sets the price. And the price is the important signal. Every CEO of these companies in Europe knows 2 carbon prices. They know the permit price, which is currently 70 euros per ton, but the CEO also knows another price, and that is the internal cost to cut emissions in his company or her company. And if the internal cost is 50 euros to invest CapEx and cut my emissions, why would I pay the government 70 euros if my cost is 50? And so this calculation, or we call it internalizing the externality of carbon. The carbon price is internalized by every single company, and these participants compare it to their internal abatement cost. When the carbon price is higher than the internal abatement cost, the company chooses to decarbonize. Why? Why do they choose? One reason: profit. The company is only motivated by maximizing profit. And if the permit price is 70 and my internal cost is 50, by reducing my own emissions at a cost of 50, my profit is higher. So the carbon market harnesses the strongest incentive, profit, to achieve the second most important objective, least cost abatement. It means if we look at all of the companies in Europe, this is the price per ton of abatement. And these are all the different companies in Europe. Some companies, their cost to reduce their emissions is 200 euros or 300 euros per ton. But some companies, the cost is 10 or 20 or 30 or 40 euros per ton. And if the carbon price is $50 per ton, we can come across here all of these companies here, they will make more profit if they cut their emissions rather than buying the permit and giving the money to the government. Because the top of the bar is the internal abatement cost. And after this company, they decarbonize, then the next year, we move to the next group of industries or companies, and then the next company, and the next. So we climb the marginal abatement cost curve over time. We climb the MAC curve to achieve full abatement of emissions through time. And the important thing here is that we pick the low-hanging fruit first. The companies with the lowest cost to cut emissions, they cut. We begin with the lowest hanging fruit, the highest efficiency, and the market is the most efficient. The price signal of the carbon market, trading now 2 billion euros per day, means that this is a liquid market and the price signal is widely disseminated to all these companies. But a liquid carbon market also allows these companies to hedge, and it incentivizes investment into low carbon technology. And the final point about the carbon market is when the government sells the permits, this auction revenue from the sale is used and reinvested into energy efficiency and low carbon initiatives. In Europe, 100% of the revenue, which is billions of euros, is reinvested into energy efficiency and low carbon initiatives. So to summarize, how does the regulated carbon market work? Number one, it caps and lowers emissions. Number two, it ensures that emission reductions are achieved at the lowest possible cost through the price signal and a liquid market. Number three, the revenue from selling the permits is reinvested into low carbon initiatives. And I would summarize by saying at LSE, we studied all of the mechanisms and policies. This is a smart mechanism. This is a very, very smart mechanism. But really, the question is, does it work? Does it actually work? I'm pleased to tell you the carbon market was launched in Europe in 2005. And from 2004, emissions in Europe were 4.2 billion tons that year. And last year, emissions were 3.1 billion tons. The annual run rate of emissions has dropped by more than 1 billion tons per year. This is a run rate of emissions. In a world of 36 billion tons, this is making a dent. It's been very, very successful, particularly at moving Europe off of burning coal to gas and renewable energy by providing that crucial price signal. Now, coal, of course, burning coal has many other negative aspects, air pollution, lung disease, etc. So that's been very, very good. This success in Europe with the carbon market has caused many new countries to launch carbon markets, and this is very good news. So today in our fund, we invest in 5 carbon markets. I'll just show you on the map. So Europe, number 1. UK carbon market is market number 2. After Brexit, of course, the UK, which was in the European carbon market, then launched its own carbon market. Market number 3 is California on the west coast of the US. Market number 4 is the RGGI market on the east coast of the US, which is 10 US states together in one carbon market. And market number 5 is New Zealand, down here in the bottom right. So these are the 5 markets that we invest in today. These are all liquid, regulated markets run by the government. But there's many new markets. China has already launched the biggest carbon market in the world. It covers 4.5 billion tons of annual emissions. This is enormous. Europe, 1.4 billion, China, 4.5. This market is not open for investment yet, but the Chinese have already said they will open the market. Same thing with South Korea. Mexico has completed their pilot program. They should launch before the end of this year or the middle of next year. Brazil has passed their first legislation to launch a carbon market. Japan is launching a full carbon market. Indonesia, Philippines, Malaysia, Thailand, and Vietnam. All of the Asian tigers are at various stages of looking to launch a carbon market. So when we began our research 5 years ago, carbon was trading 10 billion per month. Today, carbon trades 60 to 70 billion per month. And we believe in 2 to 3 years, it'll be trading over 200 billion a month when China, Korea are up to speed. And within 10 years, carbon will overtake crude oil as the most heavily traded commodity on the planet. And then we believe it'll stay there for many decades. So the asset class has huge importance in the energy transition, because clearly having a price on carbon makes renewable energy more attractive versus fossil fuel alternatives. So understanding carbon as an asset class helps you understand the overall energy transition and what's happening in that space. And we're seeing many institutional clients now, including last month, our first sovereign wealth fund. Really, they're interested in understanding carbon as an asset class because of the role in energy transition globally that it will play. So let me tell you a little bit about our academic research paper, the carbon risk premium. We also published a CFA case study you may have seen called Carbon as an Asset Class. A couple of quick points. As I mentioned, carbon markets are trading 60 to 70 billion a month. Mainly this is in the exchange traded futures market. This is a monthly graph over the last year or so. And you can see we've been around this average of 70 billion a month, mostly in futures, although there's some volume in auctions as well. Here on the left, you can see a performance graph of these carbon markets. And I guess the first thing you see is, there's really no correlation between these are the five carbon markets that we invest into. They all have unique aspects, unique policy drivers in each market, and they're very, very uncorrelated to each other. If we specifically look at the European carbon market, California, the RGGI market, and New Zealand, and we look at the rolling 36-month daily correlation, we see that these four carbon markets are not correlated to commodities, real estate, European equities, US equities, bonds, and hedge funds. No correlation. And this was something that we expected. But this was surprising. Carbon markets have zero cross correlation. The pairwise cross correlation is also very, very low. And of course, this has big implications when you're thinking about portfolio construction, when you have 5 asset classes effectively with no cross correlation. Very, very important. So carbon has this key property, zero correlation, and yet it also has the other key property we seek. When we look to include asset classes in our portfolio, normally we seek 2 things. One, we seek asset classes with a positive expected rate of return. In equities and bonds, we look for the risk premium. We also want asset classes that have low correlation. This is why equities and bonds have been good combinations, because they've been uncorrelated. So carbon has low correlation. We believe it also has a unique policy risk premium. What do I mean? Well, we understand, how does a carbon market work? What is the goal of a carbon market? The goal is lower emissions. And the only way we achieve lower emissions in the economy is a higher carbon price. When the carbon price climbs the marginal abatement cost curve, as the price goes up, emissions go down in the economy. This is a very strong relationship. As the price of carbon goes up, emissions go down. So all the politicians, they all know we need a higher carbon price to achieve the Paris Agreement. Now, the Bank of England has done a calculation. They say we need $150 per ton by 2030. The IEA, very well respected, says we need $130 per ton. These are four very well respected estimates of a 2030 price. And we take an average here of $120 a ton. And then we just ask a question. Where is the price? What is the carbon price? So we built a cap-weighted index of the 5 carbon markets we invest into. And you can see, if you see the graph here, it begins on the bottom left, $25 per ton. And then we see the COVID drop. And then we have a big increase to $85 per ton in 2021. And then we have a drop in carbon prices in 22 and a drop again in 2023 last year. But the price is around $65 per ton. So we built a risk premium calculator. What do I mean? If today you buy carbon passively, buy and hold, passive investment, at $65 per ton, you buy all 5 markets. If the price reaches $120 per ton in 2030, we built this risk premium calculator. And this gives you a 6% prospective risk premium as a passive investor in carbon. Now, there is no commodity that I know of or asset class that has a positive expected risk premium. Equities and bonds do because they have coupons, cash flow, and this drives a risk premium. But with carbon, no commodity has a positive expected rate of return because commodities have no coupons, there's no cash flow. But we believe that carbon has a policy risk premium, and therefore there is a forward-looking prospective risk premium if the market is to achieve its function. And its function is abatement. So we need higher prices. Now, this calculation is if we reach 120, this generates a 6% risk premium. It's important when we use the term risk premium, this refers to a premium over the risk-free rate. At the date we did this, 7-year US Treasuries were 4.2. So the total nominal return is 10% per annum. There is no asset class that has this tailwind like carbon. And certainly, I have traded convertible bond arbitrage, merger arbitrage, many trading and investment strategies in my career. It's always good being investing in something with a tailwind, not a headwind. And carbon has a definite tailwind. So if you found this interesting, I encourage you to email me. I will send you our academic paper. It will give you the full information about this asset class. It's very, very interesting. So I hope that gives you, and maybe some people will have some questions. I want to close by just telling you a little bit about our fund, the World Carbon Fund. The goals of the fund are to generate absolute return over rolling 12-month windows. So even if carbon is negative, we want to generate a positive return, and we also want to create a direct impact on climate change. Just very quickly, compliance carbon markets are successful. They're growing. Our fund targets absolute returns over 12-month periods with impact. We now have a 4-year track record, 20% annualized return, and very low correlation. The way we decided to align our interest with our investors for climate impact, we take 20% of our performance fee. This is a gross revenue for the company, not 10% of profits, This is 20% of a gross revenue stream. This is a very big commitment for our company. And we use this performance fee to purchase carbon permits in the regulated carbon market, and we cancel them. And with this commitment, the fund holds Article 9 status under the SFDR in Europe as high impact. We are now the largest carbon fund in the world by some large amount. The fund is now 460 million, so almost $500 million in size. We are growing rapidly. As I mentioned, we just onboarded recently a sovereign wealth fund, a Canadian institution, and increasingly we're having interest from larger institutional investors. The fund is not UCITS. It is a QUAIF, and it has monthly liquidity. So that is different. There's much more information on our website at www.carbon-cap.com. And just to show you a little bit of the performance, I think the important years for us was 2022 and 2023. The fund was positive in both of these years, and carbon, the asset class, was negative. So the fund goes long carbon and also short carbon, although we must always be net 10% long. So the fund is in the prospectus, we must be net 10% long. I hope you found that interesting. This is a very scary image that I think captures, unfortunately, our future if we don't move quicker on climate change. And David Attenborough, of course, is a hero and someone who's leading the charge on climate change, who I admire very much. Our mission is to raise awareness on climate change and provide solutions that are directly related to capping and reducing emissions. We plan to launch multiple additional funds, all focused on climate change and impact. And so I hope to engage with the CFA Institute as we grow and develop our business in the future. And I would be very happy now, Augusto, to take any questions.
Okay, great, Mike. Thanks a lot. It has been very interesting. I will like to start kicking a question. You have mentioned about the more official carbon markets coming soon. I'm really happy that China, that it is one of the main emitters, are actually moving towards that. And I will also like to see first, how do you foresee that market evolving? Do you think it could be investable for foreign people? And also about the markets in the United States. I'm seeing that they are more at a state level, okay, that there isn't any launch of United States own market. I would like to know more your opinion about that. Do you foresee more states going forward on that or not? And what's your opinion about other main countries that are actually very big polluters, like India, for instance? What do you foresee it can happen on that? Second question would be more related to non-official markets and that reputational risk you are mentioning. I would love to hear your opinion of what can be done. I mean, you mentioned something about more regulation or more homogeneity. What are your thoughts about making, that kind of market also helping in order to be able to have carbon offsets and to be able to actually pursue all these challenges we have in terms of pollution and emissions? Many thanks, Mike.
Thank you, Augusto. Quite a few questions there. So let me begin with the US market. So we have now the state of California, and we have 10 states on the East Coast in a carbon market. So that's 11 states. You are correct that the chance for a federal carbon price across the entire United States, this is not going to happen because politics is too polarized. However, there are multiple more states, individual states, that are looking at launching carbon markets, including New York State, Maryland, New Mexico, and the state of Washington launched their carbon market 6 months ago. It's been quite illiquid, so we have not invested in it, but it is another carbon market. So I have hope for more individual states in the US. When we look at South America, Brazil, I mean, this is a major emitter, one of the biggest emitters in the world, and they are moving legislation to launch a full carbon market. Same with Argentina, although we will have to see how things go. And when we have a carbon market in the emerging world, right? China, Indonesia, Philippines, these emerging market economies, of course, it will take longer for the market to gain liquidity and credibility. So from an investment perspective, there will be more risk. We have a very detailed market entry framework of parameters that a market must pass before we can invest in that market. And I think this is quite nice because when a fund like ours invests into a carbon market, we bring liquidity. And liquidity really helps the underlying companies to hedge, right? There's so many uses of commodity markets, right, for hedging, price discovery. So I think having a set of criteria and communicating these to the government in these countries is very important so they can raise the quality of their carbon market to achieve liquidity and have external participants. China has said they will open their carbon market to international investors. Maybe this is in 1 year, 2 years, I don't know. Probably China will be a very small investment for us until we see it develop. So I think in 10 or 15 years, there will be regional centers of carbon. So maybe there's a North American market all linked together, South America, Asia. And then maybe in 15 or 20 years, we have one link and we have a global price on carbon. This is the hope of most economists because when two carbon markets link together, Switzerland and the EU had separate carbon markets, and then the Swiss market was linked to the European market. And then by linking two markets, of course, we tap into, in one of the markets, we have the lowest cost of abatement, right? And so by linking, we achieve lower abatement cost. Your other question, the voluntary carbon market, planting trees, these project related. I can only tell you, and I can send a lot of investigative journalism, documentaries, and information on the voluntary carbon market. And most of the carbon credits that are generated from this market come from avoided deforestation. And what this means is that we develop a mechanism to estimate what would have happened to the forest versus what did happen, and we take the delta and we create credits for this. And I really think that this doesn't meet the key tests of additionality, permanence that are required for a robust carbon market. And there is some efforts to improve the situation, but until this financial asset, and it is a financial asset, until it has regulated oversight, I think you want to steer clear. We estimate in 2023 that investors in voluntary projects, in forestry and other carbon projects, had losses of 300 to 800 million US dollars last year in 2023 in voluntary carbon. So, my hope is that regulated markets expand rapidly to cap emissions and lower them, and that voluntary markets become regulated.
Many thanks, Mike. I don't know if there is any other question in the room.
Yes, I have a question.
Go ahead.
Okay. You have already talked about the integration of the carbon market. Do you think that this cap on pollution is unfair with the developing countries that are now polluting because they are growing?
Yeah, so I think this is a very, very important question because the damages caused by climate change that are occurring today are because of emissions from the last 80 years. And the bulk of those emissions come from Europe and the US and Canada, whereas the emerging world has smaller emissions. And yet we are now, asking the emerging markets to stop emitting. So I think that because the impact of climate change hits everyone on the planet and probably hits people in India, Pakistan, Bangladesh, in these countries even more than in the West, where the West has government funding and resilience and programs. I think it is relevant to encourage emerging market governments to look at how can they launch a carbon price in their country, like Vietnam, an emerging market country, is now looking at launching a carbon market to encourage the transition from fossil fuels to clean energy. The good news is solar and wind are now on a cost per megawatt basis cheaper than many fossil fuel sources. We have intermittency, so we don't have base load, but as we develop industrial scale batteries for the grid, then really we can accelerate the move to renewables. So I think this is a very difficult question to answer in a few minutes, but I think you can make a good argument that climate change is a global problem and we must all implement policies to address it. Someone had a question. They posted, should the carbon price per ton be the same across the world in all markets? And could it be arbitraged, I think. So if you read our academic research, you will see that we cover the pricing across the different markets. Each carbon market has a different scope of coverage. So in the RGGI market, for instance, it only covers the power sector. In California, it covers the power sector plus transportation plus heavy industry. In Europe, the European market only covers the power sector and heavy industry. So each market has a different scope of companies that are covered and sectors. And this also means the abatement cost and the price per ton is different. So eventually when the markets link, of course, then the prices converge. But until then, we have different prices in different markets.
Okay. Any other question?
Someone.
Hello. I would like to ask, how could these schemes cover the one of the major emitters of CO2, which are cars? Cars of not perhaps big companies, perhaps air companies can be charged and enter these schemes, but individual cars.
Do you mean yeah? So when you're talking about transportation as a sector,
yes,
yeah. So in the California market, the way they do it is there's a carbon price per ton at the wholesale fuel. So at the refinery, before it gets sent to the pumps where people pump it into their tank. So they charge the carbon price at the wholesale level, where it's much easier because it's the massive oil refiners when they produce the petrol for the cars. So this is in the California market where the carbon market covers transportation emissions. Europe is now launching a separate carbon market just for transportation and buildings. So this will be a separate market. It will have a separate carbon price.
Thanks.
Great. Well, is there any other questions? If there's no other questions, then I would like to thank everyone for attending tonight. I hope you found it useful. If you want to receive any more information, please get in touch and we can send you further information. Also, if you go to our website, we have an educational library on our website at carboncap.com. We have educational videos and a research library with a lot of research on climate change, carbon markets, emission trading systems. So there's a lot of resources available to people. And thank you, everyone, for having me today to present. I hope it was helpful.
Thank you, Mike. We will share this recording with all the CFA Institute community. It has been really a pleasure to have you here. Thanks a lot.
Thank you, everyone. My pleasure.
Thank you very much.
Wishing you a good evening. Bye-bye.